Scenario 1, Stone Company. The invoice price of a machine is 500,000 pesos. Various other costs relating to the acquisition and installation of the machine, including transportation, electrical wiring, special base, and so on, amount to 75,000 pesos. The amount has an estimated life of 10 years with no residual value at the end of that period. The general manager of Stone Company suggests that the incidental cost of 75,000 pesos be charged to expense immediately for the following reasons. First, if the following machine should be sold, this cost cannot be recovered in the sales price. The inclusion of the 75,000 pesos in the machinery account on the books will not necessarily result in a closer approximation of the market price of this asset over the years because of the possibility of changing demand and supply levels. Lastly, charging the 75,000 pesos to expense immediately will reduce income taxes.
Having clarified the ethical issues brought about by the aforementioned points, I shall now discuss as to how they should be treated. Firstly, these costs should not be expensed, as evidently they are necessary to prepare the machinery for its intended use. Thus, according to PAS 16, they should be capitalized. Further, the argument that the costs are irrecoverable is invalid because depreciation, by its nature, allocates the benefits enjoyed by the entity from the asset over a more reasonable and protracted period of time. Secondly, as this is the initial measurement of the machinery, it should be at cost as per PAS 16, and thus market fluctuation should have no bearing as to how they should be treated. Lastly, while expensing these costs would bring about an immediate reduction of the current year's income taxes, capitalizing them will bring about the same result by means of depreciation, and additionally, it is more reasonable as it accurately reflects the condition of the asset. Thus, we as aspiring accountants, complying with ethics and practical reasoning, have come to the conclusion that his arguments are unsound, and thus the 75,000 pesos worth of incidental costs should be capitalized, in line with PAS 16. That concludes our discussion for Scenario 1. Now we move to Scenario 2.
Scenario 2. In this scenario, Gerald Bueno, the accountant, favors placing a very high proportion of the cost in the warehouse itself, wherein it reduces taxable income and income taxes. Andam, his supervisor, argues that allocation should recognize the increasing value of the land, regardless of the depreciation potential of the warehouse. Besides, she says net income is negatively impacted by additional depreciation and will cause the company's share price to go down. For this case, what stakeholder interests are in conflict? What ethical issues does Bueno face? And how should these costs be allocated? We have here the stakeholders' interests that are in conflict in this scenario. Transparency, as Bueno intends to place a very high proportion of the cost in the warehouse to reduce taxable income and income taxes. This could see if its investors relies on accurate financial statements. Thus, long-term growth is influenced. Due to the over-allocation of cost for the warehouse, high chance that the investors will feel misled as the value of the warehouse is not in market value. High chance of investors being discouraged in investing, which affects long-term growth.
Moving on, Bueno, being the accountant, faces several ethical issues in the cost allocation of the recently purchased properties. This includes the conflict between accurate financial reporting and attaining financial goals, and the potential for misrepresentation of financial information. First, accurate financial reporting requires the cost to be allocated based on objective fair market values typically established through an independent appraisal. This ensures a truthful and reliable picture of the company's financial condition. In contrast, both Bueno and the general manager and Dam are motivated by financial outcomes, that is, to reduce taxes and improve reported earnings to protect the shareholders' perception. Now, if either party's preferred allocation is adopted without proper evaluation evidence, it may lead to inaccurate portrayal of the company's assets and performance. Overstating the building's value could artificially increase depreciation, lowering reported profit, and overstating land value might preserve earnings but understates the true cost of operations through reduced depreciation. Now, this creates the potential for financial statements to be misleading, affecting investors as well as regulators and tax authorities, in that it may trigger regulatory issues or tax audits and potentially damage the company's reputation.
So how should costs be allocated? From an ethical standpoint, the company should determine the relative fair values of land and building in the purchase date to allocate the total cost of acquisition appropriately. The relative fair value approach is widely used to divide a single purchase price between land and building. In many cases, the land will be worth more than the building due to factors such as location or market trends. So how does this work? First is a market analysis or qualified appraisers needed to estimate the separate fair values of a land and building. So suppose the total cost of the property is 10 million. So based on appraisal, let's say land is worth 6 million and the building is worth 4 million. So land there's still is 60% of it and 40% for the building. So there's a journal entry 6 million, 4 million, 10 million. Land and building are recorded as asset based on the proportional fair value. So cash or notes payable reflects the total amount paid for the property. Next, we record the annual depreciation for the building. So assuming the building has a 40-year useful life using straight line method, so 4 million divided by 40 years is equals to 100K annual depreciation. So the journal entry. This ensures the cost is fairly distributed based on actual market values rather than tax benefits alone, in the correct asset allocation and expense recognition in financial statements. While it's true that depreciation reduces net income, it's important to clarify that this does not necessarily cause a company's share price to decline. Depreciation is a non-cash expense and many investors focus on the overall financial health and cash flows, not just net income. Therefore, ethical and accurate asset allocation should not be influenced by concerns over temporary reductions in reported profit. So what are our recommendations for scenario 1 and scenario 2? Scenario 1, stone companies should capitalize all acquisition and installation related costs, including the 75,000 in incidental cost, as part of the machine's total cost. These are necessary to prepare the machine for use and therefore must be recorded as part of the asset, not expense. So while expensing the 75K might reduce taxable income in the short term, it violates accounting principles and misrepresents the financial position of the company. So proper capitalization ensures that the expense is matched with the revenue it helps generate over the machine's 10-year useful life. So charging this cost to expense would result in understating asset, overstating expenses in the current year, violating the matching principle, and potential issues with auditors or tax authorities. In the scenario 2, Stone Company should hire a qualified appraiser to determine the fair market values of the land and building. So using the relative fair value method, the total purchase price should be allocated proportionately. This ensures that the allocation reflects economic reality, avoids manipulation for tax benefits, and complies with accounting standards like the GAAP or IFRS. So the land should be recorded as non-depreciable asset and the building should be depreciated over its useful life. So this approach promotes transparency, supports ethical financial reporting, and aligns with stakeholders' interests. Our conclusion for scenario 1 is that the incidental cost of acquiring and installing the machine should not be expensed immediately. Instead, they should be capitalized and depreciated over the machine's 10-year useful life. So this treatment ensures compliance with accounting standards, promotes accurate financial reporting, and aligns with the principle of matching cost and benefits. So while immediate expense may offer short-term tax advantages, it misrepresents the long-term value of the asset and could undermine financial transparency and stakeholder trust. So scenario 2, our conclusion for that is that companies should determine the fair market values of the land and the warehouse at the same time of purchase and allocate them accordingly. This method supports ethical financial reporting, maintains investor confidence, and ensures accurate and transparent accounting records.